Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. Wednesday, February 11th, 2026. Stocks flirted with record highs early, then turned into a sideways grind. The setup was simple. The jobs report came in stronger than expected, and bonds did the talking. Yields moved up, rate cut hopes got trimmed, and the major indexes finished basically flat to slightly lower. But the real story wasn't the close. It was the rotation, semis, and energy held up, while big software and internet leaned on the tape. On the S&P 500 Heatmap, this was a split board. You could see mid-tone green across energy, industrials, semis, even staples. But the tape felt heavier, because several giant boxes were red, especially in megacap software and internet. So even with a lot of names holding up, the index never got the follow-through you'd expect off a risk-on morning. That heat map split, it was basically the money flow. Capital rotated toward areas that looked more insulated from higher yields, energy cash flows, industrial cyclicals, and quality staples. And on the growth side, traders still wanted AI infrastructure, semiconductors stayed bid. The funding side came from megacap software and parts of communication services, and with rates staying firm, small caps lagged again. Here's the tension the market couldn't resolve today. Reuters reported payrolls rose to about 130,000 versus roughly 70,000 expected, and unemployment edged down to 4.3%. That's solid growth, but it also hardened the higher-for-longer worry. Traders trimmed near-term rate cut expectations, even as June is still framed as the next likely cut window, with growing odds of no move then. You could feel it in yields, with the 10-year hovering around 4.17 to 4.18. Quick chatter check. Two narratives were floating around, mostly because they tug on positioning. First, oil carried a risk premium tied to U.S.-Iran tensions, including chatter about an expanded U.S. military posture, not a confirmed catalyst. Just the kind of story that can keep energy bid. Second, there's ongoing talk that parts of the tech software complex have become a key drawdown pocket this year, with the AI disruption narrative hanging over the group. Today's jobs report looked solid on the surface, but the details matter. U.S. employers added about 130,000 jobs in January, and unemployment edged down to 4.3%, but more than half of those gains, roughly 82,000 jobs, came from healthcare alone. For over a year, healthcare has quietly carried the U.S. labor market, while hiring in retail and manufacturing has stalled. The driver is demographic, not cyclical. More than 10,000 Americans turn 65 every day, boosting demand for nurses, caregivers, and medical staff. Expanded coverage through Medicare, Medicaid, and the Affordable Care Act has amplified that demand, but that pillar may be weakening. The One Big Beautiful Bill Act, signed last year, is projected to cut nearly $1 trillion in Medicaid spending over the next decade. Analysts warn that reduced funding could flow straight into healthcare job losses, threatening the sector that's been propping up headline employment. So markets are asking a harder question: if healthcare hiring slows, what replaces it? Today's report says the labor market is still growing, but it's more concentrated, more fragile, and more exposed to policy risk than the top-line number suggests. Micron was the loudest expression of what worked today. Micron jumped about 9.9% after the company said it began volume production and shipments of HBM4. In a session where software felt heavy, the market still rewarded AI picks and shovels exposure. That helped explain the internal split. Semis could be green, even while the Nasdaq leaned lower. Microsoft mattered today because of its weight and because it sat in the weak part of the market. Microsoft fell about 2.15% as yields stayed elevated and the market kept repricing the AI CapEx and ROI debate in megacap software. In a tape with plenty of green elsewhere, this is the kind of red box that stops the whole index from feeling healthy. Alphabet was another big weight pulling against the broader rotation. Alphabet dropped about 2.39% as communication services and internet names sold off. With names this large, you can have decent breadth and still feel like the market's stuck. And that's what today was. A tug of war, not a breakout. JP Morgan was a key tell in financials. JP Morgan fell about 2.34% even as yields moved up after the strong jobs print. The tape read that rate move as restrictive, not supportive. So alongside software weakness, banks added to the cooling risk appetite feel. Exxon was the clean, visible pocket of strength. Exxon gained about 2.62% as oil rose around 1%. The backdrop, U.S.-Iran tensions added a risk premium even as a large U.S. crude inventory build capped the move, in a mixed tape that helped keep the market anchored in cash flow leadership. Robinhood was a sharp reminder that this is a stock pricker's tape. Robinhood dropped about 8.91% after fourth quarter revenue missed expectations, and guidance pointed to higher expenses. Commentary also flagged crypto revenue weakness as a key overhang. On days when policy-sensitive risk appetite cools, moves like this can make the speculative corners feel a lot thinner. Now the question is whether today's repricing actually sticks. The next real catalyst is Friday's CPI. Markets are set up for that print to decide whether the resilient jobs delayed cuts trade extends or snaps back. Into that, keep an eye on yields and on whether leadership stays narrow, semis and energy holding up, while mega-cap software and internet either stabilize or keep acting like a funding source. So that's the day, flat to slightly lower indexes, but a very active internal rotation. Strong jobs data pushed yields higher, the market trimmed near-term cut expectations, and leadership stayed narrow, AI infrastructure and energy on one side, software, internet, and banks on the other. Next up is CPI, and the big question is whether the generals stop leaking or whether rotation stays the story. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.